Open account terms. What is an open account? An open account is an extension of credit to the importer from the exporter. In this type of transaction, the goods are shipped and delivered before payment is due. Payment terms are usually in 30 to 90 days net. Obviously, this is the most advantageous option to the importer regarding cash flow and cost terms, but it is consequently the highest risk option for an exporter. This method is appropriate for exporters who are confident that the importer will accept shipment and pay at the agreed time, and that the importing country is commercially and politically secure. Factors that may affect the use of open account terms include secure trading relationships or markets, competition in the global markets, and the risks that the exporter faces. The international money transfer is more frequently used to settle trade debts than bank draft due to its speed of transmission, reliability, and that funds, when received by the exporter, are immediately available. It is possible to substantially mitigate the risk of non-payment associated with open account trade by using such trade finance techniques as export credit insurance, forfeiting, factoring, and export working capital financing. Open account terms may help win customers in competitive markets if used with one or more of the appropriate trade finance techniques that mitigate the risk of non-payment. Exporters using open account terms often mitigate risk by using these trade finance techniques. Here are some you should know. Export working capital financing. This is a loan or revolving line of credit which helps exporters extend open account terms in the global market by covering the entire cash cycle from the purchase of raw materials through the ultimate collection of the sales proceeds. Export credit insurance. This provides protection against commercial losses, default, insolvency, bankruptcy, and political losses, war, nationalization, and currency inconvertibility. Export factoring. In international trade, the exporter transfers title to its short-term foreign accounts receivable to a factoring house for cash at a discount of the actual face value. Factoring enables an exporter to ship the goods, and the factor assumes the financial risk. The factor handles collections on the receivables from the importer. The factoring house usually works with consumer goods. Forfeiting is a method of trade financing that allows the exporter to sell its medium-term receivables, 180 days to 7 years, to the forfeiter at a discount in exchange for cash. With this method, the forfeiter assumes all the risks, enabling the exporter to extend open account terms and incorporate the discount into the selling price. Forfeiters usually work with capital goods, commodities, and large projects.